Welcome to Clever Money Hacks, a channel that follows where money moves and life improves. In today's episode, we'll discuss the surprising power of spare change. We are diving into a concept that, on the surface, it sounds a bit like wishful thinking, right?
It really does.
Can you really take the cost of a daily, almost accidental purchase, that $5 for a fancy coffee or snack,
Yeah, something you don't even think about.
and consistently invest it and have that truly be the path to a seven-figure future?
It's a common skepticism, isn't it? The whole idea of the $5 a day challenge is so simple that I think a lot of people just dismiss it.
Right.
But our sources show the power is really in two things: consistency and accessibility. You don't need a huge lump sum or some kind of finance degree to start building wealth.
You just redirect one tiny expense.
Exactly. Just one tiny daily expense toward a long-term goal.
Okay, so let's unpack this and get really specific for everyone listening in 2026. Our mission today is a deep dive into the mechanics, the math, and, well, the cold, hard realities. We want to know, how long would it actually take to reach $1 million just by committing $5 a day? And, can you achieve that goal realistically in today's world? And then what practical steps should you take right now in 2026 to get started?
And of course, we have to say it, our mandatory disclaimer. Everything we're talking about here is for educational and informational purposes. It's not financial advice for your specific situation. We're just analyzing how this stuff works.
Right. So let's start with the engine. How does this tiny daily deposit turn into anything, well, significant? Most people think wealth building is about a brilliant stock pick or some massive windfall.
Yeah, lucky break.
But here, the magic is something way older and, frankly, less glamorous: compound interest.
Indeed. And, while a lot of people just think of compounding as earning interest.
The classic definition.
The classic definition, yeah.
Yeah.
We need to elevate that concept a bit. It's not just a slow roll. It's exponential growth that's really fueled by time. When you invest $5 today, that money starts working immediately.
And the next day is $5.
Well, when you add another 5 tomorrow, you're not just adding to your base. You're investing on top of the returns you earned yesterday.
The sources call this a financial flywheel. In the early years, the momentum is pretty much all you. Your contributions are the fuel.
That's the critical distinction. For the first decade or so, you are doing all the heavy lifting. But as time goes on, the investment gains, the growth start contributing more than your cash does.
So there's a crossover point.
There is. After 20 years, the returns, so the interest and dividends, are doing way more work than your daily $5 deposit. And that shift, when the compounding becomes self-sustaining, that's where the growth becomes truly staggering.
So consistency is the superpower here.
It really is. Sticking with it, especially in the beginning, is everything.
Okay, let's ground this in some actual numbers from the source material. You commit to $5 a day, that's about, $1,825 a year?
Roughly, yeah. And let's use the long-term historical average for the stock market, say a 7% annual return.
What does that look like?
Okay, so after just 10 years, your total cash contribution is $18,250.
Right, the money you put in.
But because of that 7% compounding, your account would likely be sitting closer to $26,000, that nearly $8,000 difference. That's pure growth.
And if you stretch it out to 20 years, it gets even better.
Far more acute, yeah.
Yeah.
You've personally invested around $36,000, maybe $37,000, but your total value would be approaching $75,000.
Wow. So your gains are almost equal to your total contributions at that point.
Exactly. And that's the point where people really start to see the potential.
Yeah.
It shifts from, I'm just saving a few bucks, to I have a real growing asset.
Okay, so now let's hit the heart of the matter. The million-dollar question. Is it mathematically possible to get to $1 million starting with just $5 a day in 2026?
Mathematically, yes, absolutely possible. But the real challenge here is the timeline. And this is where we need to get into the nuance. If we're sticking strictly to that conservative 7% annual return, and you only contribute the $5 a day, you're looking at a commitment of 45 to 50 years.
40 to 50 years. That is a lifetime.
It is. It demands incredible patience and decades of continuous commitment.
But what happens if you can do a little better? What if, maybe through better investment choices or just a good market cycle, you average 9% instead of 7%?
The difference is immense. That little 2% rate difference over decades doesn't just shorten the timeline by a few years. It completely changes the outcome. At 9%, that timeline drops to closer to 40 years.
And at 10%?
At a sustained 10% average, You might hit that $1 million target in the mid to high 30-year range. The power of a small improvement in your return rate is just exponential over that much time.
But we have to bring in the harsh reality that every long-term investor faces. Inflation. What does that $1 million actually buy in 40 years?
That is the essential caveat, isn't it? It's what separates an informed investor from a novice. If we assume the historical average inflation of around 3%, that nominal $1 million in, say, 2066,
It's not a million anymore.
it has the purchasing power of maybe $300,000 to $350,000 in today's 2026 dollars.
So the goalposts move. If you want the buying power of a million today, the challenge gets a lot harder.
A lot harder. To get a real inflation-adjusted million in 40 years, you'd need your investments to reach closer to $3 million nominally, just to account for the dollar getting weaker.
Which is why, as we'll get into, increasing your contributions over time isn't just a nice idea, it's basically a requirement.
Exactly. It forces you to ask, is this challenge really about the $1 million? Or is it about building the habit? For most, it has to be about the habit.
That's a perfect transition. If the goal is habit formation, let's pivot from the theory to the practical steps. How do you start this right now in 2026? And step one is just finding the $5. Sounds trivial, but it's invisible for a lot of people.
The first step is just awareness. That $5 is usually hiding in plain sight, disguised as convenience.
Like what?
We're talking about the bottled water from the store, the premium streaming service you use twice a month, or that daily specialty coffee that's probably more like $6.50. You just need to cut one of those.
The sources mention transaction leakage. We track our big bills, but the small recurring payments just bleed the budget dry.
Totally. And if you do a quick audit, cancel 1 or 2 subscriptions you forgot about, a gym you don't use, you can easily free up 10 or 20 bucks a month. That more than covers it.
And this leads right into the tools for 2026. You're not just using a spreadsheet anymore. We're talking AI budgeting apps.
Right. The top platforms our sources cited use machine learning to automatically categorize your spending, and this is the key part, they predict your recurring micro expenses that you might miss.
Give me an example of how that works.
Okay, so one of the leading apps for 2026 financial tracking. It doesn't just tell you spent $35 on coffee last week.
It's proactive.
It's proactive. It flags patterns like you spend an average of $5.15 at the corner deli every workday. Redirecting this habit would fund your entire investment challenge. It just makes finding the money and setting up the transfer almost effortless.
It solves the inertia problem. You make it automatic. Okay, so you've found the money. Now you need a place to put it. For a beginner with just $5, the platform choice is critical. What are the must-haves?
For this challenge, 2 things are non-negotiable. First, commission-free trading. If you're paying a $5 commission on a $5 investment,
You're going backward.
you're going backward, exactly. And second, and maybe most important, is fractional shares capability.
Explain why that's so critical for this strategy.
Well, a single share of a big tech stock or a popular ETF might cost hundreds of dollars. With only $5, you're locked out. But fractional shares let you buy, say, 0.01 shares of that security.
So you can get in the game immediately.
Immediately. It allows for instant diversification across high-quality assets without having to save up for months just to buy one share. It completely removes the barrier to entry.
And here's a pro tip from the sources, a real growth accelerator. Start with $5 a day to build the discipline. But as your income grows, you get a raise, a bonus. You have to commit to increasing your contributions.
Lifestyle inflation avoidance.
Exactly. If you bump it to $10 a day after 5 years, you dramatically shorten that timeline to real wealth, and you keep pace with the inflation we talked about.
It's a crucial step.
So you've got the $5, the app, the platform. Now, what do you actually invest in? What should you be researching for a long-term, low-maintenance strategy?
Keep it simple. Focus on diversification. When you're dealing with small daily amounts, trying to pick the next big stock is a fool's errand. The most straightforward path is using broad market index funds or ETFs.
Specifically ones that track something like the S&P 500.
Or the total U.S. stock market, yeah. They offer instant diversification. You buy one share of an S&P 500 ETF, and you own tiny slivers of the 500 largest U.S. companies.
So one company having a bad year won't derail you.
Precisely. It minimizes that single company risk. Plus, they're low cost, passively managed, and have historically provided those 7% to 10% average returns we've been using as a baseline.
Okay, beyond just tracking the market, is there a strategy to, supercharge the compounding for a $5 investor?
Yes, you can look into dividend-paying ETFs or stocks. A dividend is just a piece of a company's profit that's paid out to shareholders. The key is setting up a DRIP, a dividend reinvestment plan.
So the dividends you earn automatically buy more shares.
Automatically. The money you get from the dividend is used to buy more shares, often fractional shares, of that same asset without you doing a thing.
That's a powerful idea. So you get the market growth plus this automatic injection of cash from the dividends, all of which starts compounding immediately.
Exactly. It's an acceleration loop. You're reinvesting your $5, and at the same time, you're reinvesting the profits that the investment is generating for you. It's the best way to automate and maximize compounding when you're starting small.
Okay, before we wrap up, we have to talk about the risks. This isn't a savings account.
No, it's not. And that's crucial. Every listener has to understand there are no guaranteed returns. The 7% and 10% figures are just historical averages. The value of your investments can and will go down.
You have to be ready for the bad years.
Absolutely. There will be market corrections, downturns that could last for years. This entire challenge only works if you stay disciplined during those bad days and resist the panic sell urge.
That long-term commitment is the real risk management tool here, isn't it? If your timeline is 30 or 40 years, those dips just become blips on a much bigger chart.
They do. The foundation of this isn't about finding the perfect stock. It's about building the discipline to consistently invest money you can truly afford to set aside and, well, forget about for a while.
Don't invest your emergency fund.
Please don't. Don't invest money you might need in the next 5 years.
So what's the big takeaway for you listening? The $5 day challenge. It's really less about the nominal $1 million prize at the end and more about realizing that building wealth is an accessible habit. It's not some exclusive privilege. It shifts your focus from needing a huge amount of cash to start to harnessing the incredible potential hidden in these small, consistent, everyday choices.
That's the real magic. It's the behavior modification. It makes saving and investing an automatic, almost invisible part of your daily life. By the time you really notice the dramatic growth, the habit is already locked in.
So a good first step is just finding that one expense.
Yes, we'd encourage you to think about that right now. What is one single expense you could cut today to fund your first $5 investment? That's where it all begins.
Thank you for listening to today's episode. We hope to see you again. Bye for now.